Hello and welcome back to Harvesting Income. Today we are going to discuss about an interesting fund which is called RYLD. This is basically a Global X Russell 2000 covered call exchange traded fund. So we are going to look at if it is a good small cap yield machine, if the fund is, a good yield generator or not. And I'm also going to share a few other covered call ETFs based on the Russell 1000. So please stay tuned till the end. Before we go ahead, I'll do a quick disclaimer. This video is for information or knowledge sharing purposes only, and nothing is, financial advice or investment advice. Do your own due diligence before you make any decisions or consult with professionals. Okay, let's get into the fund. So what is RYLD? It's basically known as the Global X Russell 2000 Covered Call ETF. Global X is the name of the fund, and so that's the name of the fund you see on the top. And the fund has two different aspects in terms of strategy. First part is fund will purchase stocks in the Russell 2000 index, and the second part they write or sell call options on the Russell 2000 index in order to generate regular income. And when they generate that income, that would be distributed to unit holders in the form of distributions. So that way, fund is able to give you monthly dividends. What is Russell 2000 index? It's basically an index of small cap companies and also a few mid cap companies. Typically, the companies which are smaller than $1 billion in terms of market capitalization. And another important aspect of the fund is when they write the call options, the fund writes options at the money, so the strategy is purely income oriented, meaning the fund is not able to capture any upside when the market goes up. The fund will not be able to capture much of an upside. However, they will be able to capture some premium income, which will lead to more income or distribution for the unit holders. This is a good fund for income investors or pure income investors. So that is something to keep in mind. Let's look at the other basic features of the fund, like key metrics. And the ticker symbol is RYLD. You're already familiar with that. And price is 16.75, $16.75. Fund was started back in April 2019. So now it has about 5+ years of history. And also they have a bigger asset base, $1.5 billion. So I would say this is a pretty big fund and a decent sized one. And they have a net expense ratio of 0.6%, which is very reasonable, and I would say middle of the pack. It's not too low, it's not too high. And for a covered call exchange traded fund, this is reasonable. So this is the data from the fund website. I'm also going to look at the returns of the fund and the dividend yield. So that will be interesting now. Total returns, like total return would mean like two forms of returns. Any fund would have dividend returns and also price returns, like when the price appreciates or depreciates. That's one part of the return. And when the fund pays you dividend, that's another part of the return. So some funds would be paying dividend. Some funds just give you the appreciation. Some funds give you both. So in this case, we have both. When I look at the total returns of RYLD, I looked at the website Dividend Channel or the tickertech.com. The total returns per year for the fund since it was launched is about 19%. Let me highlight that. So 19% return in that 5 year period. So 19% every year. So that's the return we achieved from RYLD. However, the index itself, the when I look at the IWM, which is the index exchange traded fund. So I'm taking IWM, which is the iShares Russell 2000 Index Fund, as a comparison. So when I look at IWM, they have delivered about 58%. IWM is a very plain vanilla uh, index ETF. It's not doing any covered calls or any other strategies. They just invest in the index. Just by investing in the index, they are able to make 8% total returns. Whereas RYLD, despite all the covered call, they are still making 19%. Of course, one can argue that covered call ETFs underperform the market. However, in this case, the underperformance is there's too much of underperformance, I would say. So look at the graph here. If you invested $10,000 in the IWM, you would have made about 15,846 by now. But if you had invested in the RYLD, you stand at 11,921. So there's a huge gap. Like RYLD's returns are like not even one third of IWM's returns. So that's a poor performance. So this is something to keep in mind because the past performance gives you some kind of indication. We never know what will happen in the future, but so far it's not been that great. Let's look at the other aspect, which is the dividends. So I looked at the Russell dividend yield, which is about 1.2%. Obviously, the index exchange traded funds don't give higher yields. Let's look at the RYLD's dividend from December 2023. So when I just looked at the dividends, you can see that it's about 16 cents, few fraction, up and down, but it's almost around the 16-cent level every month. So when I add up these dividends, it comes to about 1.97 dollars for the last 12 months. So for the last year, about $1.97 of dividend were earned for the fund. The price of the fund is 16.75. So based on that, the dividend yield works out to 11.7%, almost close to 3%. It is a decent yield. Like I would say, it's a good yield for a fund like this. And for income investors, this is a good option in terms of the dividends. But the capital appreciation part of it is not good enough. So just to quickly sum up, next page, I'm going to quickly look at the pros and cons. The fund is good in terms of dividend yields, and you're able to get close to 12% yields, and that too from a small cap fund, which is interesting. And the good thing is like you are able to diversify beyond the large caps into a lot of small caps plus some mid cap companies too, which means like for someone who is having a very big portfolio of blue chip stocks or bigger index funds, considering exposure to RYLD will help diversify into a newer space or a smaller space where there could be newer opportunities or potential returns that you can get. However, the exposure has to be limited because there is a lot of risk. And the returns can be low and it can be pretty unpredictable and volatile. The other side, if you look at the cons, like it's poor or no capital appreciation, like in the last few years, which is concerning, and there's a low returns for the RYLD fund, and also it's losing its value, it's losing its price or value over a period of time. Uh, I mean, this is concerning. So due to these factors, like we also need to look at other funds with similar strategy or other funds which are also, investing in the Russell 2000 index. So let's look at what other options we have. Like, and I look at the alternate small cap income ETFs. Like there are two or three which come to mind. This is not a recommendation. Keep in mind, this is not a recommendation, and this is just my own analysis and some of the funds which I like. And before I go ahead, just small warning, like these funds are pretty new in the market. Some of them are like 6 months, 9 months old. So take everything with a grain of salt because these are funds with a low track record, pretty new to the market. So we cannot really know what's going to happen in the future. However, these funds look promising. Probably we can keep track of it. So first one which I like is IWMW, which is from iShares. It's iShares Russell 2000 Buy Right Exchange Traded Fund. This was launched in March 2024, so it's about 9 months now. And expense ratio is pretty decent, 0.39, and price return is 0.37% negative. However, dividend yield is 18%, so that's interesting. IWMI is slightly, more interesting because it has a slightly higher expense ratio, but price returns are 4% and dividend yield is about 14%. Like compared to the first one, the second one is able to, generate price returns too. So it has a 6 months history. The good thing about Neos funds is that they are able to capture some extra upside because of their ability to buy out of the money call options. and capture extra upside. So that's why they're able to generate some price returns too. So pretty interesting. A lot of new funds are coming up with different strategies. And the third one is more interesting because they also offer weekly dividends. This is from the Round Hill funds, and this is called the Small Cap Zero DT Covered Call Strategy ETF. Pretty long name. So basically, they write zero date options, the options which expire on the same trading day. So every day they're writing options, which means that there's a lot of activity, a lot of transactions. And since it is an active fund, there's a lot of activity and expenses pretty high. So the expense ratio obviously is high. And they also pay weekly dividends. And so far, they have been maintaining a stable NAV, net asset value, and also have decent appreciation potential in addition to steady flow of dividends. However, this fund was just launched in September 2024, hardly 2 or 3 months of history. Like, so I would not recommend anyone to jump into this. Keep observing this, and I hope you like this video. And if you like what you've seen so far, or if you want me to cover any of these funds in the future videos, please drop in your comments or feedback below. I look forward to hearing from you. And thank you. Have a great day.